It's a direct impact of the uncertainty around India-US trade ties. The Indian Rupee for the first time plunged below the 90 per dollar mark, crashing 230 paise in just 27 trading sessions. It hit a record low of 90.14 within moments of the market opening, drawing a psychological line in the sand for traders, importers and policymakers. The fall caps a year-long slide that has already eroded more than 5% of the rupee's value against the dollar. At the start of the year, one US dollar bought about 85.5 rupees. By September, the rupee had weakened past 88 and through November it drifted steadily closer to 90. On November 21st, the rate was hovering near 89.6 before finally breaching the 90 mark today. The move has been gradual, but the final push to 90 has come in just the last few sessions. So why is the rupee losing its value? Several factors are pushing the rupee lower. The India-US trade deal is seemingly nowhere close to completion. And the red carpet India is rolling out for the visit of the Russian president, the optics are clearly against US tariffs being slashed anytime soon. Other reasons include caution among foreign investors who are pulling money from Indian equities going back to the US dollar. Fears of a growing trade deficit due to tariff wars. The RBI meanwhile is believed to be intervening but has so far allowed the market to test the 90 level.
Tariff case in the US Supreme Court, if I'm not mistaken, that is still being argued. Outcome will be known. And if it goes against President Trump, then I don't know what situation US economy will be into. So this pressure is creating a little bit of problem. And there is a little bit of mixed view on 5th of December, Abba, that because rupee is at its all-time low, there might be a status quo as far as rate cut is concerned. This is some part of the market that feels that. I am of a personal opinion that at 0.25 basis cut is definitely on the cards. Statements from the RBI governor will be important.
The impact of a weaker rupee will be felt immediately. Everything priced in dollars will be more expensive. This includes foreign-made electronics, mobile handsets to key industrial inputs. Families paying for foreign education or overseas holidays also face a direct jump in costs. Many companies see will margins squeezed as dollar-denominated inputs turn pricier. A weaker rupee also makes crude oil and gas imports costlier, all factors which eventually will feed into consumer inflation. But there are some winners as well. Exporters, especially IT, pharma and specialty manufacturers, receive more rupees for each dollar of revenue, improving their competitiveness if global demand holds up. Households that receive remittances from abroad also see higher rupee inflows. The big question now is whether the RBI chooses to draw a firmer line around 90 or allows the rupee to find a new range. Much will depend on the path of US interest rates, the dollar's strength, foreign flows into Indian markets and where crude oil settles. For households and businesses, the impact will ultimately be felt through prices, borrowing costs and confidence, making the rupee's next move a key macro signal through the months ahead. Bureau Report, Business Today TV.
If you like the video, do like, comment, share and subscribe.